Hi, I'm Owen, the host of the Australian Finance Podcast. This podcast is proudly sponsored by BetaShares, one of the leading providers of ETFs here in Australia. Serving thousands of financial advisors and over 1 million investors, BetaShares manages tens of billions of dollars on behalf of investors right across the country. I'm proud to partner with BetaShares on the Australian Finance Podcast, Australia's premier financial podcast, because there is great alignment in the long-term philosophy shared by both businesses. I hope you enjoyed this episode of the Australian Finance Podcast. Phil, welcome back to the podcast, mate.
Thanks for having me.
It's always good to record in person. You've got your wonderful shirt on, the toucans.
Yeah, I have a rule. I need to wear the loudest shirts possible.
That's right. I like it, mate. You've got the Skye YouTube channel here, and I can see that there's some other shirts and these types of things. And the Skye team, I feel like it's fair to say, is always up for a bit of fun.
Yeah.
Yeah.
We try.
Yeah. So that's awesome. You can check out Skye Wealth on YouTube. Phil has appeared on the show many times before. He's a insurance specialist, also financial advisor, but specializes in insurance. So we'll talk a lot about life insurance, how to review your cover, the different types, whether you can get insurance inside your super, get it paid for by your super fund, the pros and cons of that, and a few other things like income protection, which I know everyone wants to talk about because it is really important. Phil, we've done a long form. We did a mini series on this before. We do have the downloads. There's also ways for people to get in contact via the Skye website as well.
Yep.
We've got Skye. Should I say Skye Private?
We can say it's skye.com.au is our main website, and we've got Skye Private, but people will be fed there if they need to. Yeah.
Okay, so Skye, SKYE. I know a lot of people have been through the process with the team. I myself have as well, and our team. I think a few. Monique's on the register over there. She's nodding. Adrian. I think a few of the team are going through the Skye process. Yeah, which is great. So first things first, a lot of people, when it comes to insurance, the first question they should ask themselves is, why do I need it? Or maybe for our podcast today, it's like, why everyone listening to this should at least consider it, Phil.
Yeah. I mean, at the end of the day, the way I like to think about insurance is we all love the upside of investments. We all want to, progress financially, and that's kind of what a lot of the listeners are thinking about. But we've always got to have some downside protection. Like, we don't go all in on crypto because it's too high risk. It's the same as insurance. So we make sure we funnel a little bit of money out of our income to pay for these insurance covers. It's just to protect the downside risk of something catastrophic happening. So that's kind of why fundamentally it's important. If you have income that you're relying on to build wealth, if you have family who are relying on your income or relying on your ability to care for little ones, it's really important that we have insurance in place.
Absolutely, it is. So we'll talk a little bit more about the different types in just a moment, but chances are if people have a super fund or something like this, or if they've seen a financial advisor in the past, or just even generally they've taken it upon themselves to think, oh, hold on a second, it's not necessarily just me here. I've got to watch out for my partner or even business partners or kids or what have you. I guess one of the questions that people might have just straight out of the gate is like, how do I review what I've got? Is there a way to do that?
Yeah. So if first place to go is your super fund. So super funds, they're legally required to consider insurance for all their members. And so when you join a super fund, as long as you're over 25, as long as you've got a certain level of balance, they will set up a default level of cover. So it's always the first place. Log into your, Oz Super, Host Plus, wherever your super is, and there will be an insurance tab there somewhere. If you can't find it, just give them a call and say, hey, is there any cover in place for me? That's your first place. Next is, if you don't have any through your super fund, you would have likely have either not have any at all or set it up individually. So if you've gone through a financial advisor before and you think you remember you set up insurance, feel free to reach out to that advisor or just go into your Gmail account and search, life insurance. Maybe you've got something
in there. Yeah, that's kind of my default. Whenever someone sends me a bill, I'm like, "What is this?" Oh yeah, that's right. Yeah. I signed up last Christmas. Yeah. Okay.
Well, I had a car crash and I try to work out. Wait, am I insured? I typed in all the different insurance companies because I'm pretty sure my wife set up the car insurance. So that's what I did. I freaked out for about 10 minutes.
All right. Was it a bad car accident?
No. It was fine.
Well, you're here today.
It was, it wasn't bad. It was just going to be expensive. approved.
Okay, right. Yeah, gotcha. Okay, so I would like to go through the major types of life insurance or just insurance. I think we can bucket all of these under life insurance. Phil, we've got income protection, TPD. I'll ask you to explain what that means. Life insurance, trauma, and child's cover. Those 5, do you bundle them all under the umbrella of life insurance?
Yeah, they're under the category of life insurance,
Yep.
and legislated under the Life Insurance Act. Yeah.
Okay, great. So there's other types of insurance that people should be familiar with: car insurance, home and contents. They're all what we call general insurance, and they're different. Maybe I'll give you just a quick, very briefly, like what's the difference between life insurance and those general insurances?
I mean, general insurance, the insurance provider can change the contract every 12 months. So every renewal, they can decide not to insure you anymore. We know about flood affected areas where the insurance provider may decide they won't cover floods anymore. So that's under the general insurance contract. They can make some adjustments. Under the Life Insurance Act, they can't actually make any changes on you. So if you claim on your income protection for a bad back and then you go back to work, they're not going to exclude your back because you've claimed in it before. But general insurance, they can.
Yeah, we've all seen the news headlines or even experienced it ourselves where all of a sudden the definition of things changes or just that. It seems like really unfair stuff, whereas life insurance seems a bit more strict and likely
it is
to support
if you own the contract. Now, if you're through the super fund can make some adjustments because they're insuring their members and you're not insuring yourself directly. So there is a little bit of nuance there that the super fund can make some adjustments as they choose. We
should talk about that in a minute. Actually, that's a good point. But okay, so the major types of insurance. Can you explain the 3 big ones as far as I'm aware? Income protection, TPD, and life. We've done a full series on this, so I will share the links for people that want to dive deep into those individually. We also have a guide for people to go through and check some things off. It's brought to you by the team at Skye. Let's start with income protection. I'm going to come back to this in a minute. So if you can just give us what does it protect for? Why is it important? Yeah, so income protection is your loss of income if you're injured, ill, or sick. So that doesn't matter if you hurt yourself at work or when you're on holidays and you're still employed, then you get your income replaced at a certain percentage. So it's not fully replacing your income, it's 70%. What it doesn't cover is if you get made redundant or you quit your job and you're between jobs, you don't get paid any income protection. It's only if you can't work for injury or illness or sickness. Yep. Okay. TPD, that's an acronym. We love acronyms in finance. What does that mean and what is it for? So total permanent disability or disablement. So it means that you basically can't go back to work ever again. So you're totally and permanently disabled. I think for most people that I speak to, Phil, that's probably the one where we'll cover life insurance in just a moment, but this is probably the one where most people get quite concerned because they have a disability that affects income, but they also feel like it may actually affect my family on an ongoing basis as a liability in the form of extra support or care that I might need. So that's a really important consideration for people. But the third one is life insurance. I don't think you like to refer to it like this, but if I think about what it would say on the tin, it would be death insurance because that's kind of what it covers. Yeah. What is life insurance and how is it maybe a little bit different? Yeah. So, I mean, life insurance is if you pass away, there's a lump sum payment. Some policies, if you're terminally ill and you've got you're unlikely to live more than 12 months or 24 months, they'll pay it out early, but it's effectively you're going to be passing away or you have passed away. Yep. Okay. So income protection's like a ongoing monthly replace most of your income sort of thing. And then you've got life insurance, which is a lump sum paid to you. And disability is a lump sum as well. Yep. Okay. And then trauma. This is one that is probably a little bit, it sounds like TBD. Can you tell us about this? Yeah. So trauma is for severe medical events. So the main ones are things like cancers, heart attacks, and strokes. They're kind of the big 3. Cancer makes up a huge portion of claims for trauma insurance. So, I mean, we can all think about someone who is in our vicinity that we know has had cancer. On the YouTube channel, I actually asked my daughter, 11-year-old, if she knows anyone who's had a trauma event. And she, we didn't name anyone on the video, but afterwards I said, oh, who are they? And she named 5 different people, within our circles. And, me and Kate are under 40 and, she's like, auntie this, auntie that. And so
that's what trauma is for severe medical events. It has very clear, defined, claimable events when you go and purchase it. But the three big ones is cancers, heart attacks, and strokes.
Okay. Number 5 is one that you brought to my attention. I didn't really know this was a thing until last time we spoke, which is child's cover.
Yeah.
Again, it kind of seems intuitive what it covers, but can you just give us the kind of the overview?
Yeah, so child's cover is a kind of a mini trauma policy and a life insurance policy.
Okay.
So if there's severe medical events, and so things like, major burns or cancers, or if your child passes away, it's a lump sum policy that gets paid out. And so really a lot of people think it can be a bit, some people can feel uncomfortable. Well, we've got an insurance policy over my child. But I just think about, in reality, if one of my kids was to pass away, do I want the financial freedom to take time off work and grieve with my family and look after my other two daughters? 100% I would. And so it's not about profiteering at all off the death of a child, but it's about just provide us that financial security to be able to just have that pressure valve off and just
100%.
go, let's just focus on family.
Is there, for child's cover, is there like an age range that you can get it, but you can't get it? You know what I mean?
Yeah, there is. Most insurers want the child to be over 2 years old. Some will do over 1 year old, and then up to a certain age. So some will stop it at age 16, some older.
Oh, right.
And then the good thing about the child's cover is it can, once they become an adult, it can convert into a life and trauma policy for an adult. So the benefit of that means that if you have any health or the child has any health issues as they're growing up that's maybe not claimable, then they get a full life insurance and a full trauma insurance policy, again, depending on the insurer.
That's a really important point that you mentioned there, is like you mentioned like exclusions and those types of things people should be aware of, right? It's like a really, really important part of the overall assessment of getting insurance is your insurance may not be the same as mine. We might, if we talked about car insurance, you and I might have the same insurance. But if we talk about life insurance, even at the same insurer, we have a different policy, right?
Yeah, exactly.
So you mentioned before, and this is relevant to a lot of people on the show, whether it's because they're down to a single income or maybe they are just thinking, is there another way to fund my premiums and what I pay for my insurance cover? There's the option to have some insurances inside super, meaning the super balance pays the premium for us. Can you just talk broadly? I know this is, we did a whole episode on this.
Yeah.
But can you just talk broadly to make people aware of maybe some of the major pros and cons?
Yeah. So what can and can't be paid inside super? Let's just touch on that. So life insurance, disability insurance, and income protection all can be funded through the super fund. Child's cover and trauma can't be funded through super. Those three policies that can be, you can also hold them outside of super as well. So it's not required to be inside or outside of super, but you've just got the options.
Yep.
So super policies, if it is, if you set it up through a financial advisor and you are the individual policy holder, then before I was talking about how the insurer can change the terms for general products, they can't do that if you are the individual policy holder. So you can still be the individual policy holder and your super fund can still pay the premiums.
So that's a benefit of going through the advisor.
Yeah, exactly. Yeah. But if you go through your super fund, it's a group policy. So the group, the super trustee, will make a decision on, do we need to change terms and conditions on the policy to bring the overall cost down, because they're insuring their whole member base. And so that's when things can change. So if you go through the super fund to increase your cover through the insurance provider through the super fund, that's when they can change. So even though the Life Act says that they can't make any changes, the policy holder is the super fund. So the policy holder can make some
So it's like
changes.
There's this like, even though if you just go with the default or like you just go through Aussie Super or whoever, there's a chance that the actual thing could change a little bit between now and 10 years time versus you can still have the super pay if you go through an advisor like yourselves or something like that.
Yeah. So, I mean, Oz Super is a great example. So their insurance provider is TAL, T-A-L. So if you go through Oz Super and increase your cover, the insurer is TAL.
Yep.
Now, those terms and conditions between Oz Super and TAL may change over 10 years. But you can have an Oz Super balance and you set up an individual policy with TAL and your Oz Super still funds the premiums.
Yep.
But that policy can't change over time.
Okay.
So there's a little bit of nuance in that, but basically, if you're the policyholder, The insurer can't change anything.
So the certainty that people would get through using an advisor to set it up would be significant, I'd imagine.
Yeah.
If you understand what you're doing.
Yeah. Exactly. Yeah. And then the other differences between super and non-super is some features and benefits can't be funded through the super fund. So disability insurance, there's at a high level, two different options: own TPD and any TPD. So can you do any job or can you do your own job?
Right.
So that own is a much better definition. You're a bit more certainty at claim time that you'll get paid out if I can't do my job, even if I can work in a bakery, which I did when I was a teenager. And so that feature can't be funded through the super fund. So if you're going directly through the super fund and not through a financial advisor, that you just can't. You're just going to have any occupation. But through a financial advisor, we can split the cover. So most of it's funded through super under, 60% of it's any, and then the other 40% is that extra feature.
Yeah, right. So this is really important nuance there. You worked at a bakery.
Yeah, when I was 14, that was my first job.
Oh,
my
wow.
girlfriend at the time was working there, and my siblings worked at Macca's, and I couldn't get a job because my brother must have been a peanut. And so they did, I had 3 siblings work at Macca's, and then I couldn't get a job, so I worked at a bakery.
Nice. That's still pretty good.
Yeah.
That's really interesting you say all this, because I've got my insurance, my wife and I, through Australian Super, and we set it up years ago, and we got a massive life. Like, we went way beyond the default level of cover. I actually don't know who the underwriter was at the time. I'm assuming it was still Tao.
It was, Tao's been with Oz Super for a long time,
Yeah, right. Okay. And so that's really interesting, because then maybe I could have just gone and seen a financial advisor at the time and probably set up with the same policy or whatever. Speaking of, I wasn't satisfied at the time with the default level of cover, because we had we knew we were going to get a mortgage, we'd probably have kids. The business was spinning up then. Do you find, this is a very broad statement, and the best answer from most financial planners is it depends.
Yeah.
But do you find that on average, when someone comes to you and Skye, that the default level of cover is not right?
I'll give you a much more certain answer. 99.99% of the time, it is way underinsured.
Okay.
And we got over 2,500 clients, and I can tell you we've never seen a default level of cover that's appropriate. The level of cover as you get older, so the default cover changes over time. So if you go into your insurance guide within your super fund, you'll see a table at the age and the level of cover for life and disability. It caps out for Oz Super. I think I'd have to look at it again, but I think it caps out at under $200,000 with life and disability cover. And the disability cover comes down really quickly when you're in your mid 30s and late 30s. And so that level of cover may be appropriate if you're really close to retirement, because you got only a few years until retirement. Less than $200,000 may be appropriate, but for most people, in their 30s, 40s, and 50s, you still got, 30 years until retirement probably. And so that level of cover, I've rarely seen it to be an appropriate level of cover.
Yeah.
And everyone who's listening can literally just go in, because I'm conflicted. Obviously, we help people set up insurance policies and that's what we do. But go into your super fund, log in and check the level of cover. It's almost never enough.
So I've got this thing here. I think I've got it for whatever. It doesn't look like it's a lot of money at all.
The insurance guide?
Yeah, so this is an age-based cover amounts and weekly costs for a member with blue collar, individual work rating. 2-year benefit period and 60-day waiting period. Yeah, it never gets over 200,000.
For life and TPD.
For death, and it's got...
I think it caps at 179K. Is that the highest?
For blue collar, it's 183.
183.
Yeah, so and that's at age 32, 33. So early 30s, and then it falls away rapidly.
Yeah, I'm 38, right? 38? Yeah, 38. What's the default for a 38-year-old?
171, but it's a few years from you and me yet, mate. But at age 50, it's 80 grand.
Yeah.
Which, if you have still kids, if you still got a mortgage...
I mean, 170 or 181, I think you said, was the cap.
Yeah.
For disability cover, if I'm disabled and can never return to work again, that's what I keep saying to people. Do I think $181,000 is appropriate to live off for the rest of my life? And let's say we do get that income protection, and I think it's
like a 3,100 here. Is that right?
It's 3,100 per month.
Yep.
Pre-tax.
Yep.
And it lasts for 2 years maximum.
Yeah.
So you think about those two things, you know, you're getting what? Like, let's be super generous and say we're getting $100,000 for income protection over 2 years, and $170,000 or $181,000 for disability if I can never return to work again. Now, the likelihood of that happening is very low.
Yeah.
But the financial impact of it happening is massive. And so that's why insurance is important to have and consider. Is a lot of, you know, we had a young 20-year-old start in our business, and he doesn't have insurance, and he's been getting lectures all day, every day from me. And he's like, oh, I'm young. It doesn't matter. And I said, just put your income into a calculator. Let's assume no increase at all. Times it by like your annual income, times it by the amount of years until retirement. We're talking like $5,500. Yeah. And I said to him, if I gave you $5.5 million.
$5.5 million, yeah.
If I gave you a $5.5 million car, would you insure it? Of course you would. You're driving around a car worth $5.5 million.
Yeah.
And that's what your brain and your body is worth. So like being younger means that you actually need it because of the financial downside of it happening. Okay. And that's why I always talk about like it's protecting the downside. That's what insurance is. We all hope we never actually claim on it.
Mm. So I've got a couple more questions, but like if we think about like disability and life or death cover there, what about income protection? Like I said, 3,100, I think it was for the blue collar. What is okay, maybe I frame this a different way. What's like the maximum level of income protection someone can get? Like if they have, I don't know, you just tell us what it is. What's the answer?
Yeah, I mean, so it's complicated. Yeah. So the max relatively easy, you can get $30,000 if your income supports it. So really it's a percentage of your per month, sorry. Yeah, it's a percentage of your income. So if you're on $100,000, you can generally cover $70,000 to $75,000 per year.
75%.
Yeah. Max, 70 to 75%.
Okay. And so even if you had $100,000 a year income, you couldn't go and insure for $250,000 just because you're happy to pay an extra bill.
Yeah.
Okay.
Because the insurance company doesn't want you better off on claim than at work.
Yeah.
And so
otherwise you just fake a claim.
Yeah. Yeah, exactly. It's moral hazard.
Yeah. Okay. And then we mentioned things before with income protection. We mentioned things like waiting period and like the benefit period. Can you just explain what those are for folks?
Yeah. So the waiting period is kind of like health insurance excess or car insurance excess. It's like how long do you need to wait before you start getting a claim? So they don't charge you a fee to claim, but it just means that you've got to be off work for a certain period of time. So that old super default cover was 60 days, I believe you said.
Yes.
So you've got to be off work for more than 60 days to be eligible for a claim. So if you injure yourself, you're back at work in 30 days, then there's no claim payable. If you're off work for 90 days, then you'll get paid that last 30 days. If you can never work again, then you just wait that 60 day, and then as long as your benefit period lasts. Okay. Now the benefit period is how long will you get paid for? So that Australian super cover only lasts for 2 years. So if you're off work for 2 years, you wait that first 60 days and then you get paid $3,100 per month until you return back to work or until 2 years, and then it stops. Yeah. So if you can't work again, then it is what it is. Your policy stops at 2 years.
How about if I say, for example, if I'm listening to this and I all of a sudden I've woken up after COVID and it is 7 years later or 8 years later since I've done my insurance, or I just looked at it. How often should I be checking in with these types of things?
Yeah, so life insurance is much more complicated than car insurance. I don't know when the last time you set up car insurance, but it takes you 5 minutes online.
Yeah, I don't know. I got RSCV and I couldn't tell you if I've ever... Well, I shouldn't say this in the podcast, but I haven't reviewed it for a very long time.
Yeah, but if you wanted to, it'll take you 10 minutes to go
on iSelect or whatever and just have a look.
Yeah, it's super easy because the risks are known from the car insurance provider. Where do you live? That's a risk factor. How old you are, what sex you are, all of those are known knowns from the insurer. Same with house insurance. They're all known knowns. When it comes to life insurance, there's so many, known unknowns. Like, what's your mental health state like? Do you have a sore back? all of those things that you as an individual experience will have an impact on your insurance and the underwriting of that insurance. So it is much more complicated to go through the whole process and to review your cover. So that's why sometimes I say the benefit of life insurance, the life insurance provider can't change the contract on you. So as long as you haven't lied when you set up the policy, then you'll get paid out based on the terms and conditions of that policy, and they can never change their mind. So moving it every so often, if your health deteriorates or if you have any health issues, then you may be moving to a policy that has an exclusion, which your current policy doesn't.
Yep.
So it's not something that you want to do every year, just from a time point of view, and just from a risk point of view. But it is something that you want to always consider and review. We kind of say every 2 to 3 years, check in, unless you've had major life events. If you've had kids, if you've bought a house, your first house, if you've got an inheritance, they're things that we can adjust the level of cover, even if we don't move providers.
Yeah, okay. So every 2 to 3 years, check in. Otherwise, around major life events.
Yeah.
Cool. Like it. That's really helpful. Because everyone listening to this, I hope, has cover. Like, I don't know if it's just that you would get this more than me, but I don't know if it's just because I'm at kind of like the pointy end. Most people, when they come to talk to me about insurance, it's for all the bad reasons, like major life events, deaths, terminal illness. So I hear all of like the stories of people not having insurance and being desperate and not knowing what to do next. And that's what kind of filters up to me. And then I'm like, well, these are your options. I don't know how many options we have, but these are the options. You don't really hear of the person that claimed on income protection and it was the right policy because they got what they paid for, right? So everyone listening to this or watching this, please just at least review your level of cover. Okay, so...
And we're going. If you want claim stories, give me a call. I got plenty of claim stories.
Okay, yeah, I can imagine. So, I just want to maybe just go through one final section, and then anyone that's interested, you can get in contact with Skye. There's a link in your podcast player on YouTube. We have partnership with Skye, have done for a while now, and a lot of people have got insurance sorted through the team. The final question that I have for you, mate, is more around the process and what people can expect. Because obviously it sounds like, based on what you're saying, that there are certain benefits. Well, obviously there's a benefit to reviewing cover, but there are certain benefits to using an advisor, which you've talked about. But what would be the actual process? Because I know you mentioned before, it's not like car insurance. You just don't jump onto some meerkat-looking website and get a comparison. It is like more involved. So how do we go from, I should probably do something about this, and making it as efficient as possible for people, to, all right, now I feel a bit settled. I have protection for me and my family. Like, what are the steps in between?
Yeah. So, I'll talk about what we do at Skye and why we do it and why we think it's really important that whether you go to Skye or another financial advisor, why I believe in this framework. So what we do, we start a 15-minute phone call, super easy to book in online. And that's really just to get a sense of where you're at, what's your situation, just to give you some general information about the process. And we do charge a fee to provide advice. And then we get someone to fill out a massive online form. And we've made it really comprehensive. And the reason being is because you and me have very different health histories. And everyone is their own special butterfly. We all have our own health histories that, if your parents have cancer, that will impact your cover. And so we want to gather all that information as much as possible. So then we can choose a provider that's most suited for the individual, because we believe that underwriting outcomes is probably the most important thing that we can do. And so what we do is we send the medical information, we de-identify it all, send it off to multiple insurance companies and get back an outcome.
Yep.
And the difference between insurers is pretty phenomenal. One may decline the cover outright, one may put an exclusion on, and one may not put any exclusions or loadings. And another may put a loading, which means they charge you a higher premium. And so if you go onto a iSelect, I think they do, or like
one of them does.
Plenty of these comparison websites, you can check the premium difference, but the cheapest may put a loading on for medical reasons or for family history reasons. So we want to gather all that health information up front, and then we overlay the premiums. Okay, what are the right level of premiums? we will make a recommendation on the level of cover based on everyone's individual situation. And we have our own philosophy. We ask questions about what's important to you, and then we overlay our own philosophy of what we think is important based on our experience. And then we provide advice, and we stand behind our advice. So our advice really touches on three things. What's the level of cover that we think either you or both you and your partner require? What are the likely outcomes? So we can tell you up front, hey, there's going to be an exclusion on this policy. We believe there to be an exclusion on this policy for this reason. And so you can address that up front. You can have hesitations or decide not to go ahead if there's exclusions, or if there's a loading, at least we know roughly what the cost is going to be up front.
Yep.
So what's the level of cover? What are the likely terms of the policy? And then what's the cost? And then what are the mechanisms for the costs? Because one of the great things about insurance is there's levers to pull. If it's not enough cover and you want to increase your cover, happy days, we can help you do that. If it's too expensive, we can guide our clients through the process of what are the things that impact the premiums the most. Sometimes it's like the biggest number. If we bring that down, it feels like it'll impact the thing, but maybe it's the waiting period. Maybe instead of a 60-day waiting period, can we go to a 90-day waiting period because it'll have this impact?
Yep.
And so, they're the really three things that we look at: the terms, the level of cover, and the cost. And then we work with our clients to increase or decrease the levels of cover based on each individual situation, because we don't pay anyone's premiums other than our own individual policies. And so it may be all good and well for me to say, this is what I think you need. But at the end of the day, our clients need to afford the premiums. And again, we talk about the structure inside, outside, why we've recommended we look at any existing cover. So if you've got policies in place, that forms part of the review process as well. And then we make a recommendation, and then our clients decide, happy to go ahead. And then we'll go through the application process and kind of hold our client's hand through the whole process.
Yeah, great. So if anyone's listening to this and you're thinking, I'll go it alone, it's the reason that insurance is such a specialized area of financial advice is because it's not as straightforward as you might think. It's not like signing up to a brokerage account or switching super funds or something like that. It's nowhere near as straightforward for a lot of people, particularly if you're over the age of 1 year old and may have a medical history. So keep that in mind. One other thing, true or false for you, Phil, is I'm led to believe that not all insurance policies are available directly to the public. They have to go through insurers. Is that true?
Sorry, say the question again. They're not all available. No, most insurers don't sell direct.
So you've got to go through an advisor to get access to the full banquet anyway.
So if you want your super fund to pay the premiums but have an individual policy, you can only really do that through a financial advisor.
Right.
And that's not because advisors, we're racketeering and we want it to be held this way. In fact, talk to most advisors, we don't actually want to be the gatekeepers of these policies. It's just now you're in financial advice, you understand the legislative issues. Insurers don't want to be seen to be giving advice to their customers. So that's why there's this really funky dance between insurers being a product provider and this product having to be distributed through advice. So it's kind of web of legislation, but only one insurer two insurers go direct. Every other insurer goes through a financial advisor.
So basically in summary, you basically need to see a financial advisor to get the full, options on your account most of the time. And I think if you've made it this far through the podcast, well done. If you haven't already reviewed your super, now's your opportunity to do so. Just take a couple of minutes. Go away, log into your super account, see what you're covered for, assess that against what major events might you be on the line for if something was to happen. Major costs, So things like private school, mortgages, business expenses, just general expenses. Consider the 5 types of cover that we've talked about: income protection, TPD, life insurance /death, trauma, and child's cover. There are many other types of insurance that we've alluded to, but these are the 5 that we've covered today. Reach out to the team at Skye if you need help. And Phil, thanks for taking the time to join me in the office.
No worries. Thanks for having me.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.